Without objection.
Mr. President, I rise tonight following on the heels of two more bank closings in my state last Friday. Not new banks, one of them over 60 years old, one of them over 100 years old. And so I want to talk for a few minutes tonight about the unintended consequences of well-intended regulation. We're now going into the 26th month of the current recession. This will arguably be the longest recession post-World War II America's experienced. And I can tell you from having gone through 4 of the recessions post-1960, this is by far the worst of anything that we experienced. And we're at a point where we've got to make some good, solid decisions, but we've got to help our economy, help our businesses, and help our financial institutions. Now, don't get me wrong at the outset. I'm not talking about waiving or dispensing or looking the other way. I'm not talking about loosey-goosey regulation, which got us into the mess that we're in, shoddy underwriting and poor credit. But what I am talking about are realistic approaches to difficult problems and looking to our past to understand the answers for our future. I want to talk about Rule 114, which is called mark-to-market. Mark-to-market is where an appraisal of an asset held by a bank is appraised as what it would sell for today. And in many cases, because of a difficult real estate market in both commercial and residential, those values are dramatically depressed. In most cases, below the loan that's against them. So the asset deteriorates, the asset side of the balance sheet of the bank deteriorates, you have difficult problems. You know, in the late 1980s and early 1990s, we had a similar period of time. We had something called the Resolution Trust Corporation, the RTC. It was kind of a bad bank that took all the assets of the failed savings loans around the United States. We waived mark-to-market for 3 years, had a 3-year moratorium. So the banking institution and their regulators could deal with loans in a practical, pragmatic way, rather than a draconian, rigid application of mark-to-market. Secondly, we've got to consider doing something on the appraisal rules that have been passed down. And I have talked to our Secretary of HUD on this, and I intend to talk to him more about it. But you know, I was at Clayton County, Georgia, south of Atlanta, just 2 weeks ago. A county that's been hit hard by the housing recession, a county where values are 42% below what they were in 2006. That is a significant decline. And talked to one realtor after another and one lender after another who told me the interesting thing that's happening. With the new appraisal regulations, the appraisals on these houses when they sell at a short sale or a foreclosure are coming in at exceedingly low values, but when the people have to get their homeowner's insurance to insure the house, they're having to insure the house for more than they paid for it. Why? Because you can buy houses in a lot of markets in Georgia today and around the country for less than it would cost to replace them. Now, when I entered the business in the 1960s, cost to replace was the principal way in which you evaluated real estate. It later became comparable sales, took over cost to replace. I think it's time we looked at cost to replace becoming the primary mechanism to establish the value for financing purposes and for lending purposes. Now, the short sale situation is another problem. It has taken banks, in some cases, 10 to 12 months to give somebody an answer on a short sale. And a short sale, for those listening, is when you've got a house and you're in default, you can't pay your loan, but it's not in foreclosure yet. You find a buyer who can pay 80 cents on the dollar. Say you owe $100,000, they can pay 80. You go to your bank and say, will you accept 80 and forgive the 20,000 that takes it to 100 and let me sell this property to this borrower rather than foreclose? Banks were reluctant to make decisions, therefore most of the time they didn't. And those houses that they could have sold on a short sale go into foreclosure. When they go into foreclosure, more often than not, they're vandalized, their value declines 1%, 2%, 3% a month, and the house comes out at an even lower value. Now, to show you the value of some well-intended regulation, I want to commend the Treasury, because last week the Treasury issued a ruling to banks that receive TARP money that they must respond within 10 days on any short sale offer on a mortgage that that bank holds. You're going to see a remarkable change in Denver, in Atlanta, in Houston, and a lot of other places. You're going to see some sales that haven't been taking place start to take place. You're going to see some inventory be absorbed. And I want to commend the Treasury on their good approach to short sales. I want to talk a minute about loss share. The FDIC has come up with a loss share proposal for the banks that take the troubled assets of banks that have failed. FDIC says if you'll take these assets, we'll guarantee you the most you can lose is 20% of the value. We'll cover the other 80. But to make sure we don't get in worse trouble, you can't extend credit beyond 10% of the debt owed to the borrower. Well, the problem with that is a lot of these assets are in fact performing, but they haven't been completed yet, and to complete the asset so it begins to pay back, sometimes you've got to extend credit beyond 10 or 15 or 20%. To have an absolute rule that you can't is causing loans to go bad or to go unfunded that otherwise should have been funded. Mr. President, in 1974, we went through a housing recession as deep and as problematic as the one today. And foreclosures were every bit as rampant, maybe not as big in numbers, but as rampant and as difficult. And as is beginning to happen now, the commercial loans began to fail in 1975. And an interesting thing happened around the country. Commercial lenders and the regulators recognized very quickly if they foreclosed on commercial loans, like they had foreclosed on residential loans, the banking system would collapse. The asset side of most all banks would collapse. And so what they decided to do is encourage banks to work out these assets by going to the developer who's in trouble, who owes the money, and saying, I tell you what, if you'll deed this property back to us in lieu of foreclosure, and then let us hire you on an earn-out process, and so we can develop our way out of this debt rather than foreclose ourselves into a loss. And more often than not, probably 3 out of every 4 transactions it happened. The house I live in today, I built on a lot I bought in a subdivision that had been taken back by the C&S National Bank. And they had hired the developer to do a workout, and I bought it at a good price. Later did most of the sales in the development. Became a great development. The bank eventually was made whole. The bank would have lost lots of money if they had had to take that thing and foreclose on it and not worked out. So I want to encourage our regulators to give the great American ingenuity and entrepreneurship the chance to work. Sure, some of these people are in trouble, but there are avenues outside of that trouble. There's been a lot of talk about taxing banks that received TARP money. I want to address that for a second because, best I can tell, every bank that's received TARP money is paying it back in a 5% dividend. We're making a profit. The only people that hadn't paid it back are GM and Chrysler, who probably never will. But if we put that much more of a burden on top of the people that are paying us and paying a premium, when we have a banking system under stress and under regulatory duress, we're only making it more and more possible or impossible for them to stay in business, for them to be vibrant and come back to bring credit to our communities. And on that point, with mark-to-market enforced at a draconian rate, with appraisal rules driving down the values of properties that are financed by the banks, with the regulatory environment being so stiff to recognize losses and deteriorate the balance sheet, there is not any credit for small business to speak of. So we are making a recession that's deep, that is broad, and that's pervasive worse because of the unintended consequences of well-intended regulation. Now, lastly, I've enjoyed working with Senator Kaufman so much over this issue of short sales that I just want to put in one more plug for what we've plugged in this entire session and encourage the SEC. In the collapse that took place in the markets, one of the things that went out of hand was the short selling of financial stocks to terrible lows. That short selling took place in large measure because there was no uptick rule, which was the old rule that was good for years on the stock market, that once you had a declining value in a stock, if it ticked up on a trade, you stopped the short selling from continuing to take place. We need the SEC to revisit it. They took 30 days a year and a half ago and suspended it, and it helped. But we don't need those speculating in the marketplace to take unfair advantage of the values of equities that are owned by Americans all over this country for the sake of making a buck on a short sale. So my remarks really are very simple. There are unintended consequences to regulation, and we need to start looking at the cause and effect and where we can find opportunities for banks to work out, for mark-to-market to be suspended, for appraisals to be best on cost to replace rather than comparable sales. We'll begin to give the flexibility to the banking system to begin to recover, to stop the losses, stop the failures, and over time recover our economy. Mr. President, I yield back the balance of my time.